Hey everyone, this is Dylan Lawrence Moore with the Volitional Science Network, and we are here with Nima Major today because he had some issues with the last conversation that I had with Diego, who called me up with some questions about MMT. So Nima, what'd I screw up?
Something about inflation that we should talk about, but I don't know what exactly it was.
Well, I think you mentioned off the call that it was very much an Austrian economics argument that I was making, something to do with how prices were originally determined. And you mentioned that the evidence points to that prices originally were state declared.
Mm-hmm. Yeah. So when the taxing authorities declared a tax and introduced a currency, they also declared prices for commodities and goods that people could actually literally purchase from the temple authorities.
And prior to this, you're saying that there isn't any evidence that people were purchasing stuff in the sense of like, here's the price and here's the money to buy this stuff for the price.
Well, it did exist. I mean, there was also bazaars and markets, I guess, outside, but there was also certain prices that were just declared and administered from the top down. And recently, we discussed a paper by Randy Ray where he talks about MMT explanations for inflation, and so I thought that's what we wanted to talk about.
Sure. I thought it related to something that I screwed up, and it might be this, which is so as far as I understand from the Austrian understanding of inflation, the only thing that controls inflation is the supply of money. And if you increase the supply of money, you're simply going to inflate things. And if you decrease the supply of money, you will deflate things. And everything else will just kind of work itself out to make sure that happens. Yeah, is that an accurate understanding?
Yeah, the quantity theory of money, basically. Money supply times velocity equals prices times a quantity of goods.
Mm-hmm.
And MMT basically suggests that the causality is actually inverse, that business people make pricing decisions in order to obtain loans, and then to bring the goods to market, they obtain the loan and obtain the resources necessary, and then sell goods at a certain price. And the price they had in mind determines whether or not they can get funding in the first place, because the price determines revenue, and whether it's profitable. And the money happens after the price considerations. So after entrepreneurs have made their decisions about what to produce and at what price, they obtain loans, and then that brings the money, that increases the money supply.
That increases the money. So I gotta unpack that. So I, as an entrepreneur, I'm going to produce something, and I need a loan in order to get my business up and running. And that loan, because it's going to have a certain price associated with it, which is the interest rate, or essentially the risk assessment of me going into business, I got to say, okay, my price.
No, that's not the price I'm talking about. I'm talking about the prices of the goods that I'm looking to sell after I obtain the loan.
Right. Well, the cost of the loan is going to go into that. Right.
The interest, sure. The interest, well, the interest paid on the loan is going to be part of the cost.
That's what I was getting at. So the end price has to be above all this other stuff.
Yes, exactly.
Including the loan.
Exactly.
And then what you're saying, which, at first it's like, well, duh, your profits have to be more than your expensive. What you're saying is that the act of the loan is controlling the price more than just supply and demand of who wants that good or doesn't.
Yeah, the price is administered by the entrepreneur from the top down, and it's administered such that a surplus accrues to the investor or the owner of the business, and such that revenue to the business is above wages paid to the employees, so that the goods obtained cannot all be consumed by the employees, so that a surplus remains for other individuals, such as the owners of the business, but also for workers in the investment goods sector and things like that. That gets fairly complicated. But
I was going to say we just hit 80 things at once. Before I want to unpack all those things, particularly the one about the making sure that the business produces more than just the workers inside that business can consume. But I wanted to throw this at you, which is, okay, so let's say an entrepreneur decides that the price of his product is going to be $100. And an Austrian comeback that I can think of, or I guess the quantity theory of money comeback I could think of is like, well, what if the consumer demand was only willing to pay $80? Doesn't that now drop the price of the product to $80?
Sure. So there is a certain, there's a possibility that there's an adjustment process after the fact, and realized prices don't necessarily have to be in line with expected prices, but it all starts with the expected prices is the point. And the expected prices, the price that the entrepreneur sets to sell his product, the products that he's planning to sell, are not set with clearing the entire market in mind, or creating or representing the relative scarcity of the goods that he's selling. And
that's the point. Yeah. Well, let's reemphasize that, is that Austrians say that prices reflect the scarcity of a good. And what you're saying is that the entrepreneur just decides what the price is. It's not like he puts his finger in the air and goes, well, the scarcity of the good is this, and so here's the price.
Right. And of course, I mean, I don't want to strawman Austrians. Your Austrians, of course, they recognize that the price is set by the entrepreneur, but they believe that there's a sort of an auction-style market process.
Well, that was the thing I was going to come back with. So let's bounce around on this idea for a little bit, which is, okay, you're the entrepreneur, you set the price for this product. Now, as the Austrian comeback, I would say, okay, there's three options. Either you perfectly hit the price, hooray, or you're charging too much, that then the market will pay for, or you're charging less than the market will pay for. If you're charging more than the market will pay for, I would think that the Austrian would say, you got to bring your price down until you hit that part where there's the overlap. Or if you're charging too little, that's perfect placement for another business to come up and say, hey, I want part of this action. And more businesses are going to pop up until the market gets saturated. And that's the force that...
But I would say if you're charging too much, that's when competition is more likely to occur.
Oh, but I mean, on either end, there's some, if they're not charging enough, what that means is the market's not saturated yet, and so more businesses are going to come in to try to take advantage of the fact that, hey, look, we could take advantage of this market. Or if they're charging too much, another business will come in and say, hey, I can be cheaper than this. And those are the forces that reflect the scarcity of the product.
Mm-hmm. Indirectly, maybe, but the point is just that the prices, even all those other entrepreneurs who come into the market, they set their prices to meet certain firm-specific goals. which once again is profitability. On the micro level, the individual investor wants to make a profit, wants to have a surplus accrue to the owners of the business, and not necessarily how do we clear the market?
And then let me disagree with myself now that I took that stance, which is let's say the consumer demand for my product is $40, and the cheapest I can sell it for before going out of business is $60. It's the product won't just settle down until it hits $40. I just go out of business.
That's another problem. At a certain level,
go ahead.
At a certain level, you're just forced to go out of business.
Right, and then in that case, it's not like, oh, there was just leveling effect where the thing finally hits $40. It's like, no, a bunch of people now just lost their jobs, and the investors lost out on all their money, and I look like a really bad businessman, and I'm in debt.
And the venture may never really materialize,
So, and then it's not to say we're not saying that there isn't some auction which aspect which moves the price around. What we're saying is that's not the only thing in play, and it may not be the most important thing in play. That's what you're saying,
right?
And one of these things in play is that in order for me to start this business, I need to get this loan. And there has to be some sort of expectation that I'm going to pay the loan back, which means there's some sort of expectation that I'm going to charge a certain amount for this stuff.
Yes.
And then I got to pay myself and my investors on top of the bank and the people I'm working for.
And on top of that, as you expand your business, this cycle keeps on continuing. You're always going to be looking for loans to expand your business. And your ability to obtain loans is always tied to your ability to set prices. So you need market power.
That's interesting.
So ultimately, what that paper that Randy Ray, MMT economist, wrote, he I guess we can reference it below this video.
Sure.
He says that that's ultimately what businesses do in a monetary economy. They try to obtain market power so they can set prices, so they can get loans to expand their business, and it just keeps going on and on and on.
So, in terms of the price of the product that the entrepreneur is creating, what you're saying is the relationship between the entrepreneur and the lender has more to do with the price than the as Adam Smith would put it, the higgling and biggling of the market.
Yes, because the price is what determines the borrower's ability to repay the loan. So it's really the single most important figure that the bank needs to consider. And
for most businesses, the most important thing for the bank is the most important thing, because without that, your business isn't getting started.
Right. You don't expand your capital, so you don't get to expand your market power position.
Okay. Did you want to say anything more on that before I move on to the next one?
Yep, move on. Yeah, let's move on.
Excuse me. Let's talk about wages. I want to leave the business producing more than its workers can consume thing for the end, because that's the one I got a problem with. Mm-hmm. So when we look at wages, so now again, a businessman and
sorry to interrupt. I just wanted to say that everything we're talking about right now, it's based on a paper that discusses causes for inflation.
Good. Yeah. Thanks for being clear on that, because what we're trying to look at is the answer to the persistent Austrian and I think even Chicago school concern that if you create more money in a system, it immediately creates inflation. Mm-hmm. And we're saying that's not the case, and we're exploring reasons why that's not necessarily the case. And we're not denying that the amount of money has an impact and a power on price and inflation. We're just saying it's not this immediate. We're saying it's not the only thing, and it's not this immediate. If you add $1 to the system, you just inflated everything by $1.
It's not the cause of the inflation. We're discussing the causes to the inflation, basically, and the money is an after effect. It's not the cause. Is the point?
Got it. So when we talk about wages, now, I mean, when you think about from a business standpoint, obviously, wages that I pay my workers are the more I pay them, the more expensive my thing is going to cost. Now, the Austrian understanding, as I understand it, is that there's this negotiation between the employer and the employee. That's where the price is going to dictate scarcity, or the scarcity is going to dictate the price. Where I need workers to do this, but not a lot of workers want to do it or can do it, therefore I got to pay them a lot. Or a lot of workers want to do it and I don't have a lot of work to do, so I'm not going to pay them very much for it. And then that's what determines the price of labor. And you're suggesting that there's more to it than that.
Well, I mean, I think that's probably there's some truth to that, because I will try to find the most competitive labor for the job.
Of course, what we're saying is that's not the only thing going on, and maybe it might not even be the primary cause.
Right.
So, labor price. Now, obviously, we're going to have to get into what would things look like in a free market sort of conversation, but we'll get there. But obviously, in modern day, we have these things called unions, and unions get access to government power, and they could force wages.
Mm-hmm.
Right? You must pay us a certain amount because we got the government to say that you have to pay us a certain amount, and you can't hire anybody else in this area, or whatever they could strong arm into doing. Now, that force does have a play on price.
Mm-hmm. Yeah, unions have a lot of power in a lot of places when it comes to pushing up the price of labor, and the wheelings and dealings between big powerful unions, the power play between unions and corporations, play a big role when it comes to determining the wages that businesses end up having to pay, to a non-negligible degree.
Okay, but unions and corporations are creations of the state. Mm-hmm. I mean, the union isn't a creation of the state, more that it uses the state power to. Oh, I mean, I guess the corporation is the same thing. Whatever. Now, the Austrians come back and say, well, yeah, that's just the state tinkering with everything. In a free market, we wouldn't have that.
Could be, yeah. Could also be you have free market unions.
I was going to bring that up.
That do the same thing. But ultimately, when if we want to talk about the causes for inflation, what MMT suggests is that this power play between unions and corporations, and also the corporation's own desire to increase their markup, is increase their markup over the price paid for labor. In other words, their gross profit is the cause for inflation, is the cause for aggregate price changes.
Like the number one cause?
Yes.
Okay.
So
now,
for example,
go ahead.
Yeah. So what they're saying is that, if as a business, I'm looking to expand my business. I'm pricing my products to make a profit, and I'm pricing it above the wage cost, so that a certain surplus accrues to me. And that process in and of itself and then then I finance the process through new loan and money creation, and that entire process leads to changes in the aggregate price level. And so what they call the paper calls it incomes inflation, which is basically inflation that results from the desire of one or another group to increase their income. Either it's labor increasing their income, which means labor just pushes up the price, or whatever labor union pushes up the price for their labor. And if the business owner wants to retain his surplus, he has to push up the price accordingly. So that would be an instance where you have a redistribution of income from the consumer to the wage laborer in that particular field or in that industry where this negotiation took place.
Mm-hmm.
Or you have a businessman who just pushes up the surplus above the surplus that he's currently able to achieve to make more profit, and that in turn represents a redistribution of income from consumers to the business owner. So different ways of redistributing income that lead to prices being higher. And all of this, of course, accompanied by business loans that finance capital expansion and that creates new money. So yes, ultimately new money in this scenario is linked with price increases, but it's more of an afterthought rather than the root cause.
The increased money is the afterthought.
Yes.
Got it. One thing I wanted to add is that particularly after becoming an entrepreneur myself, and I've gotten to the point where I've had to hire people. Haven't done it full time or anything at this point, but I've had to hire people and do payroll taxes and get a bookkeeper and all this crap. Is that I think Austrian economists or subscribers to the Austrian economic theory give a little too much credit for the negotiation skill of the employee, for your average employee, where they say, okay, the employee always has the ability to negotiate a better wage with his employer, and depending on the scarcity of his skill set and how many people can do it and this sort of stuff, that's going to help him achieve the price, and whatever the proper price is, he's going to negotiate to it. Well, kind of by default, the business owner is a better negotiator than the employee,
right?
Because that's what he's doing all day. I mean, the business owner's job is to be able to negotiate to get the business going, and then he just pays the employee to crank the wheel or turn the lever. Right. Crank the wheel and turn the lever. There you go. The employee just wants a job. It's like, I just want to get paid to do this thing. I want to do it 8 hours a day. I want to go home and get my paycheck, and I don't want to do the crazy crap that you're doing.
Mm-hmm.
I'm not that good at it. So it stands to reason that the employee has an incentive to hire somebody to negotiate on his behalf.
Mm-hmm.
And it would even further make sense where it's like, well, why don't we all get together, because we're all employees and we can't negotiate that well, hire someone to negotiate for us.
Yeah.
And you naturally could have these blocks of unions that even though they don't have access to state power, still are able to pull themselves together and have more of a sway than they would as individuals.
Sure. That's how unions ideally are formed.
Right. And then they go after your throat with the state power, and it's another story. This is really interesting, where price comes first and money comes later.
Mm-hmm. Mm-hmm.
And because we're really trying to get at the cause and effect of, okay, when does inflation incur? And the Austrians point out, and it makes total sense if you only think about it that far, is that if you increase the money supply, obviously you're going to inflate it. But what you're saying is the money supply isn't really, I mean, if you multiply it by 1 million, yeah, fine. But the money supply isn't that important. These other forces are more important to determining price.
Mhm. Because they are the cause ultimately of the money supply increasing.
They are the cause of the money supply ultimately increasing. Let me think about that.
Yeah, so my desire to expand my business capital, which basically means I have to get a loan, leads me to price my products so that I can obtain the loan and then follow through to try and achieve those prices.
And that creates the money
Mm-hmm.
in now,
The
but
loan creates the
yeah,
money.
yes, the loan creates the money. But as we know, the more fundamental number isn't just the money, it's the private net sector savings. Right? So what's the because the business's relationship to the bank is a bit different from the business's relationship to the government, which is creating this private net sector savings. What's I I think I just thought of the answer. Here's my question, which is so the concern is that when the government is printing the money, and it's not actually printing it that much anymore, it's spending it into existence, but that's what people mean when they say printing it.
Mm-hmm.
When they're printing the money, they're printing it out of nowhere, and they're introducing a lot of money into the system, which is going to inflate it because you're really putting too much into the system, and it's more than they can hold. Even MMTers, if you're saying that there's a certain amount of demand, the government's printing way more than that demand, and we're going to get inflation. But I think I already have my answer, which is that the private net sector savings that comes out of the government is like 10% of the actual money in circulation.
Mm-hmm.
So if 90% of the money that's actually in circulation is controlled by this mechanism that you've described, well, that kind of nerfs the idea that the government's printing too much money.
Well, yeah. So the price increases can happen for several reasons. One is the desire to do investment spending, and then that leading to the whole process that we just talked about, where money is allocated towards investment spending that's created out of nowhere, or it could also be the government. It could also be that the government is purchasing goods and the entrepreneur is pricing accordingly because there's demand from the government that's competing with the private sector. So we have a full employment economy, and the government still expanding deficit like crazy. And the bigger their deficit, the more they will factor into the decisions that the corporations make when they price their goods. So again, we have the first example was we had investment demand, we have government demand, or we could have we could have foreigners buying goods and services inside our economy. Mm-hmm. So these three forces are all for the demand, constitute demand that business people react to by pricing their products accordingly. So, the fact that, too much net private saving leads to inflation is just one subgroup of possible reasons to explain inflation.
Okay, I'm going to introduce, I understand it's a fallacy, but you're going to know where I'm coming from when I say this, is that the money that the government prints into existence is the reserves that are required for the banks to lend out their money in the first place. So the lending potential of the banks is limited by the fact that the government prints the money into existence.
Okay. Well, no. Banks make loans when there's willing and able borrowers. So any businessman who has a good project that represents capital expansion of his business and that leads to the sale of goods that are priced sufficiently such that he can repay the loan, the bank will make the loan. And if they don't have sufficient reserves, then they will obtain the reserves after the fact. They will, in last resort, they will obtain the reserves from the Federal Reserve Bank,
which they always have access to. And
always have access to that.
There's no way to not have access to reserves.
Right. I mean, usually what happens is they'll just get them from some other bank who doesn't need them, or they get them through savings accounts, CDs, etc. But they will never be in a situation where they can't obtain the reserves that are institutionally required based on the reserve to loan ratio that has been declared.
Which I believe it's 1%, isn't it?
I think
I read that in Randall Ray's book.
Well, I think Randy Ray says it's actually institutionally it's theoretically it's 10%, but in actuality it usually ends up being more like 1%. Yeah.
Okay. Well, whatever the
Canada,
reason,
you know where it is.
It's zero. That's what I was going to bring up. It's zero.
Zero
in Canada. Which let's stay on this for a second, because this is a mind virus that I used to have, that the bank through this magical weird fractional reserve bullshit can take money and lend 10 times more than it has out. Right. And then that's why it wants your money so bad. Like, please come deposit with us, because we need that to lend out money and charge interest on money that we don't have. It's just completely not the case. It's backwards.
Exactly.
And the way it's happening in actuality is that the banks have government permission to create money. Mm-hmm. They have government license to create money. That's why they're able to do it. They do it the same way the government does, which is we have the monopoly and we control how it gets created, and we're going to extend a little bit of that control to these things called banks.
Yeah, they're public-private partnerships, basically.
So at that point, the bank has this money creation power, and then the government makes this completely arbitrary rule, and Canada proves it, that you have to have a certain amount of reserves. Mm-hmm. And the MMT argument that I've heard is that this is actually a waste of money, because that money could have been used for something else, but instead the government says you got to keep a certain amount of reserves on hand.
Yeah. In effect, it's like a tax on banks. That's all it is. The reserve requirement is just a tax on banks.
Right, because they could have been making more money with whatever reserve amount that they have. Mm-hmm. So the causality in the same way that most people screw up taxes and spending, where most people think the government collects money and then spends it, when in reality they spend money and then collect it.
They loan money.
The banks loan the money to someone who's looks like, let's just stick with business, forget houses and cars and crap. They loan money to someone who looks like they could start a business and be successful at paying the loan back, even though they're not really paying something back. I get it. It's weird. But this is how the law describes it. It needs to work. They extend that money, and then after having extended that money, they say, okay, well, what amount of reserves do we need? Oh, that much. We'll go get them.
Exactly. Every 2 weeks or so, or every couple of weeks, they have to show some average reserve balance, and they will obtain the reserves. The point is that they can always obtain the reserves at the current overnight rate. There's no possible way that they couldn't, because that would imply that the overnight rate would shoot up. So if there was ever a shortage of reserves, that would mean the overnight rate would have to shoot outside of the bounds declared by the Fed, which can't happen. This is a breakthrough, I think, that MMT has proven in their
and it's so breakthrough it almost seems silly what we thought before, where it's like, did no one ever think to like walk into a bank and ask what they do?
Right. Yeah, that was one of the strengths of Minsky, is that he hung out with bankers a lot, and he actually cared about how banking actually literally functions.
Right. And
Austrians imagine a bank where the loan officer has a screen next to him where it tells him how much reserves the bank currently has, how much he's allowed to loan out based on that. I have yet to meet the loan officer who tells me
that's the case.
Yeah.
And I also think we mentioned that a bank is essentially a public-private partnership. The extent to which a bank is so regulated that it's really hard to consider it a private organization. Because this is really hard for people to wrap their minds around, because they think of the banks, Wall Street banks taking all our money, private institutions for profit, and it all goes to CEOs and blah, blah. And yeah, there is that going on. But the essence of a bank is, first of all, they have a government license to do what they're doing. That's an action of government to extend that money out. Second, the government says, and I think I mentioned this in a previous video, that you have to have a certain percentage of certain types of financial instruments. Like, you need to have a certain amount of mortgages, you need to have a certain amount of business loans, and a certain amount of credit cards, and a certain amount of reserves. Like we just said, it's 10% or 1% or whatever the hell it is. And if you fall outside of that, the SEC comes in, shuts you down, and liquidates your ass. Mm-hmm. So, like, the private aspect of this is very limited. Like, really, really limited.
FDIC, yeah.
The federal government, whatever. But thank you for correcting me. So let's see. We talked about bank loans influencing inflation. We spoke about unions and labor prices influencing inflation. Let's talk about spot price inflation.
Mm-hmm. Yeah. So spot price inflation is where a monopoly supplier just decides to charge more for his goods. So, for example, OPEC raising the oil price in the 70s, which led to a huge inflation in the US, is an example of that, which I guess you could also say is in turn another type of incomes inflation, but it's just different from this power struggle of labor or business people trying to allocate more resources in their direction.
Well, sorry, go ahead.
It's basically the monopoly supplier of a good just deciding to charge a higher price.
Right. Well, and then with OPEC, even though OPEC is a monopoly supplier of oil, even if OPEC wasn't the monopoly supplier of oil, oil is kind of like one of these things where that's in everybody's business. Everybody's prices are determined by this price of oil. So even if there wasn't a monopoly supplier of oil, the price of oil moving down is kind of like a monopoly thing that your business needs, that everybody's business needs. So if the price does this, all other prices are going to do this because they need it.
Yeah. The price for any commodity that is in universal demand.
Universal demand. Thank you.
We'll do that to the final prices charged ultimately.
Right. Well, and
which is why in the US in the 70s, the OPEC hike led to huge inflation that was only cured when the US started deregulating natural gas, because then people had an alternative to evade to natural gas rather than oil for their whatever energy needs.
Right. And
natural gas was fixed at a high price at the time. Sorry, go ahead.
Yeah, I remember Warren brought that up in our interview with him. And he also brought this up, which I kind of want to expand this definition and see if this falls under it. Because he brought up creating the Panama Canal, where that the Panama Canal may have been like the greatest thing that affected shipping prices ever. Mm-hmm. And that the act of making the Panama Canal was deflationary, as strange as that sounds, because shipping is a universal, more or less a universal price like oil is, or a universal commodity like oil is, and that by cutting this little thing in Panama, all the shipping prices went thump. Would you say that's kind of a I'm trying to think of a way to put that and monopoly in the same sentence and have it make sense. The Panama Isthmus is kind of a monopoly, increasing the price of I know this is weird, increasing the price of goods and cutting through it, and making that canal took that monopoly away.
Well, I mean, I guess a lot of monopoly suppliers of certain services their services weren't as much in demand anymore after the Panama Canal was built because there were alternatives for people.
Mm-hmm. Anything more to say on spot pricing?
No.
I do want to bring up this. You and I had a conversation about this earlier. This is before we get into the one I keep pushing off about taxes being inflationary, because Warren Mosler brought this up, and I don't know why I never put two and two together on this. Is he mentioned that taxes are inflationary, and particularly if we look at federal taxes, because with the state taxes, you could say, okay, well, they're taxing you and they're giving you a service, so I mean that it's going to be what it's going to be. But if the federal government is taxing more than it needs to make the currency valuable, or if it seems to think it needs to take currency out of the system because there's too much, then any more it's taxing from that is inflationary, because that just increases all the prices and nobody gets any extra service for it.
Well, but also you're taking money out of people's pockets. If all that happens is a federal tax increase, all else being equal, I think it's more likely to be deflationary because there's less spending power available. So
that's interesting.
Yeah, I don't know whether it's possible that certain types of taxes, may lead to that kind of situation, but it's really not a price increase. So we talked about it the other day with sales taxes.
Well, let's skip the sales taxes and let's look at the payroll taxes. So the payroll taxes, we already talked that labor is a huge price, and payroll taxes is like another 20 or 30% on top of your labor. Just add another 20 or 30% more expensive labor. So to take that away, let's say tomorrow payroll taxes are gone. Just forget it.
Mm-hmm.
All prices would go, and the amount of money that everyone have would go up.
Mm-hmm.
So wouldn't that be a massively, in terms of just looking at the price, a massively deflationary thing?
But also, like as you just said, the price of labor goes down. We don't know that. Maybe the price of labor, maybe it all depends on the constellations. If we're in a full employment economy, and if there's competitive demand for labor, then employers will just pay whatever they used to allocate to payroll tax to their employees. So nothing will change in their cost of doing business in that scenario. And people have more money in their pockets, so they will actually drive up prices. The fact that people have more money in their pockets will have inflationary price pressures. The fact that, let's just assume you're right, and employers are paying less, then the effect of nixing the payroll tax may have a deflationary effect. But how do the two effects work against each other? What's the ultimate outcome? Impossible to say beforehand, I'd say.
Let's make a real example of this. Just play with it. Maybe we can't determine. So I hired somebody recently with my business. We employed him properly per government rules to run an excavator. And he ended up with a paycheck of, I think, $830. That was his gross paycheck. The amount of money that came out of our bank account was somewhere closer to $890. And the amount of money that he received, I think, was $701. So, I mean, if we look at this, in reality, I paid $890 and he got $701. Mm-hmm. So, I mean, we'll just round that up to $900. $200 was taken out of this $900 for me to give him that money. Mm-hmm. Now, let's say those taxes vanish. Mm-hmm. Now, I have the choice. I could say, hey, I'm just going to give you $900 and it's yours because it's the same to me. I don't care. Or I could be the cheapskate and say, okay, I'll just give you $701 because that's what you're earning to begin with. Mm-hmm. And you don't know the difference. Personally, I think everyone would split it. Where I would say, you know what? I'm just going to keep paying you the same gross. Now you get everything, and I'm saving money anyway because I had to pay something on the other side of that as well, but like almost an extra $100. I think everyone would split it. So let's say that happened, and just to make numbers easier, we go from me paying 900 and him receiving 700 to me paying 800 and him receiving 800. Now, that allows me to bring down the price $100 from the customer I charge to do that excavator work.
Mm-hmm.
But at the same time, it put money in his pocket, which, is going to get spent around to people who are going to need excavator work. So the demand for excavator work could go up, which means, I'm not going to drop my price.
Right. It's possible. It's impossible.
We don't know. Okay. It's a good thought experiment.
Reminds me of a Curb Your Enthusiasm episode where Larry David offers to help out a guy on the set by paying him a day's wage. And then later on, he figures out that actually with taxes, the guy would have gotten less. So he asks for some of the money back that he generously gave to him. So actually, you wouldn't have gotten that much money, actually.
I'm going to voluntarily introduce the state. Does that sound like a great idea to you? That's pretty funny. Sorry, I'm just thinking about charging customers and paying employees.
Fun.
Right. Paying taxes, not fun. Oh, and then, of course, I'm going to start calling this the hidden tax, which is paying accountants and bookkeepers. Because in order to pay your payroll taxes, they're so goddamn complicated. You got to hire somebody to do it for you. And so you're paying them several $100s a month in order to figure out how you need to pay all these taxes. And then at the end of the year, after paying this bookkeeper several $100s a month, you got to go to the accountant who's probably going to charge you $1,000 to do your taxes. So we can play with how inflationary that is or isn't. I would claim that it's inflationary because the bookkeepers and accountants are doing work that isn't really serving any purpose other than bureaucratic bullshit.
Well, so I mean, accountants just have to spend all their money on booze and drugs, I think, to be able to live their lives. So that's where the spending ultimately ends up.
And it turns into a sin tax, and then okay. Tax on cigarettes, 90% tax and 10% cigarette. Which I hate cigarettes, by the way. I don't like the state taxing them, but I do hate cigarettes. So
yeah,
fuck smokers.
Well, it's an attack on your body. If someone smokes around you,
I agree.
You can argue that it's an attack.
I completely agree. Okay, let's get to the thing that I had a problem with. So I took me like half an hour today just to figure out what the hell this meant. So you've mentioned a couple times now, there's inflationary pressure on a business to increase price, or there's this force on the decision of the price that tends to be inflationary, increases the price, where the business needs to have the price high enough that theoretically, in the aggregate, the workers in that business don't have the ability to simply buy all the products that the business created.
Mm-hmm.
I have that so far so good.
Mm-hmm.
Because if they were to do that, the products that business create would never actually get sold to anybody outside the business. And then it wouldn't be doing anything in the economy. It would just be this self-feeding loop.
Yeah.
So they have to raise the prices enough that the employees can't buy everything.
Mm-hmm.
So the goods and services can make it somewhere else. Now,
yeah.
I ran some math, and tell me if I screwed some math up, or I don't see why this makes sense. So let's say I got a business, and how many employees did I have here? I think I have 100 employees.
Now, just to be clear, the business on the micro level doesn't make that decision for those reasons, but on the aggregate level, that's how it ends up affecting the economy. Yeah.
Okay. maybe that's your answer to my example, but you mind if we go through it anyway?
Sure, go for it.
So let's say I got 100 workers, and in whatever time period I pay them $1,000 each, and these workers create 10,000 of whatever my product is, and I sell them for $10 each. So 10,000 times 10 is $100,000 of products that I sold. And then 100 times 1,000 is $100,000 that I've paid my workers. Now that's the price is how I would have to set them in order for the workers to have the ability to buy all the stuff that they created, right?
Yes.
However, there's more expenses to me as the business owner than simply paying the workers. For example, there's the loan and the raw materials I got to buy and the property taxes and all this other stuff, right? So let's say before I added my profit, I actually have to sell each of my products for $20 a piece instead of $10 a piece, and that's just break even. And which means that after I sold all my product, I would have brought in $200,000 and have paid my workers $100,000. So even before I've added a profit, the workers are not actually able to purchase everything. They don't have that capability. Mm-hmm. So I don't understand what this is saying, that I have to increase the profit in order to prevent this from happening, where it can't happen by definition because there's more expenses in the workers.
The markup is not all of it is profit necessarily. A portion of it is obviously administrative expenses. Portion of it is interest expenses to the bank, mm-hmm. and then a portion of that is also the surplus that you want to have left over to yourself.
Correct. And what I'm saying is, by the time you get to that number, there is no potential, according to the math example that I drew out, there is no potential for the workers to have the capability to buy all the products that they created.
Of course, there would be no business. If it was possible to have all the workers buy up all the product, then the businessman would be obsolete. Then any corollary services would be obsolete. This would imply that all you need is workers. So it's a theoretical example to think that the workers could consume away all the output. It is actually what happens in a hand-to-mouth economy that doesn't grow, if you think about it.
So then I don't understand this inflationary force then. This income's inflation.
Well, so the income's inflation comes from the fact that I have to set a markup over the wage that I paid to my workers, so that the business makes a profit.
Right.
And what that means in terms of real goods is that the workers don't consume away, don't have the ability to consume away all the goods that my business sells, because some of those goods need to be available for workers in other sectors, such as the investment goods sector. Mm-hmm. And then some of it also needs to be available to you as the businessman who wants to accumulate a surplus. And to obtain a loan, I price these goods such that, I figure out beforehand, okay, this much is going to go to the workers. This much is going to go to the profit that I earn. And then some of that so this goes back to, there can't be an aggregate profit in any economy without investment spending. Because
that's my I'm lost face.
Yeah. This gets very
What's that?
Because this gets very wonkish. But if you think about it, when you charge a markup over the wages that you pay to your employees, you produce goods that the employees that you're paying can't purchase, which allows the economy in aggregate to put workers in another sector that doesn't produce consumer goods, because those people will still need food and consumer goods to sustain themselves.
And what I'm saying from the example that I drew out is that is accomplished before I even add my markup. But by the nature that there's more expenses than the employees.
What is accomplished?
That the employees are not able to potentially buy all the products that are created with their wages. There's no way to make that infinite loop, or the regressive loop, or whatever you want to call it.
But only to the extent that you then you. The point is, you leave some of the surplus to other sectors. So you said administrative. So then, yeah. So that's why we have to leave some buffer between the wage and the price that we charge for the goods that we're selling.
Is this just a fancy way to say that there's other expenses other than workers?
This being what you said?
So,
Sure. You could count, just assume anything. We could just say anything that's not workers. Anything that any business expense, such as administrative and workers, etc. We all count those as workers, I guess. Then there's still a profit.
So let's look at that. Which is, so we're when we say workers, we're also including the workers that I'm not necessarily employing myself. Mm-hmm. So if there's someone delivering goods to me who doesn't work for me, he works for some other guy, we're including him in that.
Yes. Well, yeah, that would be your cost of raw materials, I guess, or something like that. We could include that.
Because, I mean, I get the reason why it's necessary to make sure that the business is producing more than just the workers going into it produce, because it's got to go to other places, or else what are we doing this economy thing for?
Right, especially in aggregate. The point is that, you know, we have, when we look at the stock market, right? Every year we have so much in total aggregate profits churned out by the stock market, or by corporate America. Mm-hmm. That couldn't exist even in the simplest possible economy. We couldn't have aggregate profits unless we had some businesses working on machinery or computers or other investment goods that are not consumed. And in an expanded model, we add to that the export sector and the government sector, because the government doesn't produce anything either, you know.
Mm-hmm. That's my still confused face. Okay. Well, regardless of whether or not I get this specific point.
Yeah.
Let's do a recap here, where, you know, we started and we said, okay, what are the factors that determine price / what are the factors that determine inflation? Mm-hmm. And we start off by saying, okay, well, we want to address the Austrian concern, because that's kind of the people we're trying to talk to. Mm-hmm. And the Austrian concern is that the thing that drives prices is the money supply. And what you're saying is, no, it's wait a minute. Well, the thing that drives prices is the money supply. You're saying, no, the money supply is driven by the prices.
Mm-hmm. By desired prices, yeah.
And then the forces, so the money follows the prices. It's not the prices that follow the money.
Exactly.
And the forces that go into determining what those prices are, we got things like the price of the bank loan, mm-hmm. and the ability of the business to get that loan and be able to promise to pay back. And the bank has to say, you got to charge a certain amount in order to make sure that I get my money back. Particularly, you have to have a markup where if you lose a little money or you have to bring your price down, I still get paid.
Margin of safety.
A margin of safety. Then we have the price of the labor, which has more than higgling and biggling to do with it. There's union power, and we looked at and said, hey, you know, there still could be union power even in the absence of a state.
Mhm.
There is evidence that there's natural forces to union power.
Yes.
We also looked at spot price, which is monopolistic things, and you know, the Austrian thing will say, well, you know, without a state, that's just another example of government. Well, kind of. There's things in natural monopolies that arise where it's like, okay, this one entity has control over this until other entities catch up. For example, in the sense of like Rockefeller, he more or less got a monopoly over the oil industry because he was so innovative of what to do with the oil, and by the time
also because of shipping, because he had access. He had access to very cheap shipping arrangements.
That too, which and then he did what was it, the vertical business where he owned all the businesses working with each other that helped him bring the prices down and stuff. Here's the point: he was innovative on very many levels and was able to capture most of the market share in oil. And, you know, everybody freaked out. Oh, he's got a monopoly. He's controlling the prices, blah, 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 blah. Well, at some point, the rest of the market goes, okay, how do we catch up to his level of innovation? And then the competition comes back in. That's what I mean by natural monopoly. So there are natural monopolies that arise. And so at any given moment, there might be a natural monopoly that even in the absence of a state is what I'm saying. There may be a natural monopoly that controls the price of a commodity.
Yeah, I mean, George Clooney has a monopoly on being George Clooney. You know, it's.
I wanted a joke to come out of me. Damn it!
Almost any.
But who wants to have a monopoly on being George Clooney?
George Clooney.
Yeah, right. Whatever.
But I mean, the point is, there's actually more monopolies than we think in the world, right? Almost anything is in a sense, a monopoly, if you think about it.
Mm-hmm. And then we also had the income thing, the income inflation force that I didn't really understand, and whether or not I understood it, and whether or not it's actually a thing, doesn't detract from the fact that we have other forces besides the amount of money in circulation that can affect the price and infect inflation.
Yeah, incomes inflation is basically the desire on the part of different interest groups in the economy to increase their income. And we distinguish, you know, the two big groups, labor and capital. Labor is the workers, capital is the shareholders or business owners or whatever who want to increase their profit. And capitalists increase their income by increasing the markup over wages, and workers increase their income by increasing wages.
You know, there was one we missed. Failed businesses.
Sure.
You want to run us through that one?
Well, I mean, it's just something that I was thinking, given that business expansion, business loans expand the money supply, yet the expansion of capital you would expect to... sorry, let me start over. So a business wants to expand its capital, its machinery, etc. So they get a loan for that. That loan creates new money. So there's new money chasing the same amount of resources that could be inflationary, but also the machinery and the things that come out of that ultimately would hopefully reduce prices.
Right. Yet sorry, let me. As the money goes up, the demand for, the supply of things that you can buy with the money also goes up.
Exactly.
Yes.
But then, you know, obviously there's so many projects, a certain percentage that fail out of that. So maybe that's another contributing factor to inflation, where, you know, there's so and so many projects that inject more money into the economy, yet don't increase the supply of goods available. So then, you know, you could expect to see some sort of general inflationary pressure from that potentially. You know, I would think.
Yeah. Well, and then you know what? I was thinking about this today, and this just popped into my head. Is what you described may not just apply to businesses. So about 2 weeks ago, my company got a contract with HUD, Housing and Urban Development, federal agency.
Ben Carson.
Ben Carson. Oh, that's right. I forgot about that. I went on his website because I was trying to see if I can find more contracts, which you got to be a minority to get those things, but you could always just identify as a minority, so you're cool there.
Right. You're black, right?
No. One of the things I can click on was I identify as someone who feels that they've been oppressed in the hiring process.
That's a minority.
Yeah, well, that was one of the, like, you have to click on at least one of these things to be eligible. And that was my one thing to click on. And if anyone asked me, my explanation would be, well, I'm oppressed in this hiring process because everything else I had to be somebody else in order to get hired. I'm oppressed, right? Anyway, so HUD, there's such a thing as a HUD loan. Wait, or do I have FHA loan screwed up? Whatever the case, there's a federal agency that will allow you to get a loan with 3% down. This is quite a bit different from banks typically want like 20% down, right? Because they want you to put your money where your mouth is. And the reason is, if you don't put your money where your mouth is, you're really not that committed and they might not get their money back. In fact, there's a very high chance that they don't get their money back. So what, I think it's FHA. I guess I'm confusing the relationship between HUD and FHA, but it won't matter for this example, because when people get these 3% loans, and I think sometimes they even go down to like 0%, the government, even though it allows you to get that loan at 3%, it also allows the mortgage company to get a mortgage insurance for that loan. And the mortgage insurance is high. I mean, it's like hundreds of dollars a month usually to get this mortgage insurance. And I thought about it and I'm like, well, the only reason that mortgage insurance is so expensive is because there's a lot of claims. That means people must be defaulting on these suckers all the time. And that's what I did when I went and cleaned up this place. This guy had must have had some cheap loan and it filled the place up with garbage. I only found one needle. I'm guessing he was a tweaker and was better at cleaning up his needles, but I did find one needle. Mm-hmm. So housing loans can also be inflationary if you're having to, we're making all these 3% loans that the government pushes, and they default so often the insurance on them is literally hundreds of dollars a month. Well, there's more money that's not getting paid back that just gets to bounce around into the system.
Yeah, no doubt. I mean, housing loans are definitely inflationary because they oftentimes...
Oh, yeah, they cause their own price increase.
Right. I mean, they don't even lead to a more capital expansion because usually people don't get a housing loan to to build a new house.
Wait, and that's called a construction loan. Anyway, it's different.
Construction, but a home loan is really the only economic sectors that you're stimulating is services around like commissions for realtors and the interest to the bank, but there's no
capital.
There's no capital expansion occurring in the economy. The house is just a swap. It's an asset swap from previous owner to the new owner. It doesn't add any.
And it's going to require whatever it was going to require, whether this guy owned it or that guy owned it. Mm-hmm. Mm-hmm. In terms of maintenance repairs is what I meant. Yeah, So I think we just discovered a new inflationary force.
Mm-hmm.
Housing.
Yeah, home loans are a whole separate topic that I myself haven't really gotten into much yet either. But definitely, it's a loan which is usually supposed to be for something that expands the productive capacity of the economy. A home loan doesn't do that. A home loan just turns the owner into an asset to the bank, essentially.
Yeah. Well, I mean, even an auto loan helps the production of cars, right? I mean, I think very rarely, if you sell me a used car, am I going to go get a loan for it? Right.
Yeah, an auto loan, I think, is basically usually offered by the seller by the car company that builds the cars. So that's a little different than a home loan, right? I don't know how many car loans are made for cars that are just swapped from one owner to another.
No, I think very few, but I do know some people do go to the bank and they say, "Hey, I'd like to apply for a car loan," and then they get their financing, and then they go shopping because you don't always trust the financing that they have at the.
Yeah, I mean, it's a consumer loan. Any consumer loan, in my opinion, is inflationary by necessity.
Well, shit. We're discovering factors just by sitting around talking about them.
Mm-hmm. That's how it goes.
So now, one last thing before we end this, and we've been talking for a long time. Let's hit the business cycle really quick.
Mm-hmm.
So this was my explanation to Diego about the business cycle. I think we'll see if it comes out the same way it came out before. That I don't necessarily believe in the business cycle the way the Austrians do, where it's like this inevitable thing that comes around because the Fed is messing with interest rates and making money too easily available, which is not even close to what's going on, as you and I have discussed. What's happening is that because we're unable to supply ourselves, the private sector is unable to supply itself, more or less, with net private savings, and because it naturally wants to do stuff. It wants to start businesses. It wants to buy houses. It wants to invest in capital and do all these things. It naturally uses the private loan sector to expand things. And now we both know that when the private sector expands its financial instruments, that at some point they got to get paid back. And so while that's happening, you have to have a certain amount of private net sector savings floating around for everything to stay cool. Well, if you've got a expansion in private loans, and we're leaving out the point, we're assuming that the government is not running a surplus. At some point, the government has to look at it and say, hey, these guys need more money to work with, or else this thing's going to go shunk.
Well, yeah, I mean, the government can't see that, but what they can see is the level of unemployment in the economy.
Yeah.
You know, so we're back to...
Which is the evidence that that's occurring. Right.
Yeah. Because but what you're saying, the causality is correct. You know, that the private sector goes in debt to the banking sector and
has to pay it back at some point.
Has to pay it back at some point. The more capital we expand, the more private loans we have. So the amount of the amount of net private saving, which only the government can inject, so it needs to rise in lockstep with the private sector loans outstanding, because otherwise it's indicative of the fact that the net private saving is falling behind.
Right. That's what I meant to say.
Right.
And so what I meant by when I say I don't believe in the business cycle is there's no reason to have it once you understand this.
Right.
Where if you see the identifiers that it's like, okay, we need to inject some more money into the system because there's a greater demand for it, meaning there's unemployed people, or whatever indicators we have for this. Then you do it. And then if there's room to grow, it grows. And then you do it again. If there's room to grow, it grows, and you do it again. And there's no reason for this accordion style schwack to happen.
The business cycle as we know it, according to MMT, mostly occurs because when GDP expands, private loans expand, business activity expands in general, the taxation system is very progressive in the sense that taxes tend to go up in relation to government spending, to the point where you ultimately get to a balanced budget or even a government surplus. And that's always the point in time, at least in an economy like the US, that is an import economy, where things get very heated and dangerous. And it's likely that you'll see a recession soon whenever you get to that point. And as we've discussed before, probably the best depression indicator, not probably, the best depression indicator in history has been a government budget surplus in the US. Every single time the US government has run a budget surplus, it's been followed by a depression or a very severe recession.
Well, six times out of seven, a depression, and 1 time out of 7, a recession, right?
Well, one time it was the Great Recession of 2008, which was pretty disastrous too, you know.
Well, and then I'm wondering if it was I mean, I know this sounds blasphemous to libertarians, but whatever. That it was a recession where, even though it sucked, it wasn't like 3 million people died like the Great Depression or something, right? Even though it sucked, there was not to say anything good about Obama, but there was stimulus spending that came in that kind of cushioned it. There was a welfare net, which I'm not saying is a good idea, but it there was something to fall on, and
there's no doubt that the stimulus programs that Obama enacted after the Great Recession, they were actually, the stimulus program wasn't even really a significant portion of the government deficit generated after the fact. The biggest deficit generator was the so-called automatic stabilizers, which is basically unemployment insurance. And also, just because people consume less and businesses sell less, there's less tax income. So these are all things. Now, the fact that the government didn't cut spending significantly, that certainly helped. So there was a big injection of net private savings, which kept the economy from going off a cliff, which is something I would have never said before, So,
right. Well, because we're literally saying that government interference is what prevented it from going into a full-on depression, although government interference kind of caused the problem to begin with. So,
and it wasn't necessarily government interference, but just the government sitting back, letting the automatic stabilizers kick in, and not cutting their spending. Spending that didn't increase significantly after the Great Depression. The government's spending was not the reason why the government ran a huge deficit. It was mostly because tax incomes collapsed
during the Great Depression.
Yes, Great Recession.
Yeah. Okay. Yes. Got it.
Great Depression, probably similar situation, honestly. I mean, what the lead up to it was exact same situation. Budget surplus, heated economy, net private savings gone, and then the collapse. And then at the time, there wasn't really automatic stabilizers and things like that weren't really in place the way they were in 2008, such that it didn't, end up leading to a giant year-long depression with unemployment at 20%
where people are literally starving to death and living in camps and reliving the grapes of wrath. You ever read that book?
No, but I heard about it.
Yeah. I think, if I remember correctly, John Steinbeck was a communist.
Okay.
I only read his stuff in high school, and I look back and I try to remember it. I'm like, yeah, he was pretty sympathetic to that. That way of thinking. Okay. I've had about enough. What about you?
Yeah, I think we've went all over the place, man.
All right. Okay. Well, we'll talk to you next time. Thanks, Nima.
Thanks, man.